One of the biggest questions we hear from our clients are around how do we handle non-standard transactions inside of our shop? So things like an internal vehicle that we're doing work on, a comeback repair, warranty, or perhaps the owner's vehicles or friends and family vehicle. We are big proponents. Every vehicle that enters the shop should really have a repair order written on it. It's really great for insurance, right? Obviously, if something were to happen to a vehicle in your shop without a repair order, it's going to create a lot more questions from insurance if you need to make a claim for that. So we like to start with that. However, there's some other reasons. So if we're installing parts on a vehicle, but we're not writing a repair order for it, what we're going to have is we're going to have that cost of that part, which is going to decrease your gross profit on parts, which we're looking to make decisions on pricing and efficiency when we're looking at gross profit. So if our gross profit drops on parts because we are not writing a repair order and accounting for that part, we might make an incorrect decision. Now, one of the counter arguments to that is, hey, we might be artificially increasing revenue. We might be artificially increasing gross profit. How do we combat that, right? So how we write that repair order gets very important. So what that looks like is, hey, we might be writing just a at-cost repair order. It's going to have a relatively immaterial effect on, say, gross profit percentage, car count, ARO, etc. But what it does is it tries to neutralize the effect of that repair. And that's really the goal is, right? So these vehicles that we really don't want to carry major effects on our sales, our gross profit figures, which are really the key drivers, key metrics of our shops. We're trying to avoid that. So we want to neutralize that by writing a at-cost parts ticket. And now if we have to pay our technician, right, hey, we are going to pay them at a rate. We might come up with a rate, maybe it's $80 an hour, that we make sure that covers all of our costs for paying that technician to work on the vehicle. Now on the back end, you might ask, hey, I am not getting that money. How do we deal with that, right? So what we do is we've constructed other payment types within shop management systems. So if we have an internal vehicle, right, we might have a internal vehicle expense account in which we would label that other payment type for internal vehicle. So we know then instead of receiving cash, receiving that payment, we are going to route the amount of that repair order down into vehicle expense on your P&L. And this gives you, hey, this is an actual expense for my business, right? We want to know the true cost of what it takes to maintain a shop-based vehicle. Maybe it's my own or personal vehicle. If it's not owned by the business, it's a personal vehicle asset, right? We might route that over to distributions then. Or say we have a comeback repair, right? I'm in big favor of having a comeback or internal warranty, goodwill, service policy type account on our P&L because we want to know what that cost is when that vehicle comes back in. So, right, we might create another payment type for that account. And again, while these all might increase your sale numbers, your ARO numbers, it should relatively be immaterial. Obviously, if it's material, we have other issues to think about besides ARO. Or car count, right? We want to make sure we then figure out where our QC gap is if those numbers drive up too much. But otherwise, what we want to do is neutralize that effect of gross profit, especially because a lot of us pay our service advisors on gross profit. So we might pay them a commission on gross profit. If that gross profit number is inflated, right, hey, they're going to get overcompensated. However, if we add a cost only on there, hey, we're actually taking money away from our service advisors. That does not help incentivize them. I hope this helps. If you have any questions, feel free to reach out.